Today we are going to do capital structure. And this is the sixth part of the chapter on financial management. Now let's understand what we are going to learn in this. First, we'll understand the concept of capital structure and then the factors affecting it. What is capital structure? Capital structure is the mix between owners' funds and borrowed funds. That means a combination of debt and equity. We have already done this before. So the finance manager has to decide as to how much of debt should he raise and how much of the money should be by the owners. Now, for that, he has to balance profitability as well as risk. Remember, debt was very cheap, but equity was expensive. But debt had a lot of risk and equity was not that risky. So he has to make a balance between the two so that the return to the equity shareholders is the maximum. Now, is there anything called optimum capital structure also? No, there's nothing called optimum capital structure. Any capital structure which increases the return to the shareholders is called optimum capital structure. Now, when the optimum capital structure is to be decided by the finance manager, when he's working on the capital structure, if he uses more of debt, then we say it is high leverage. What is financial leverage? Financial leverage is the use of debt. So if in the capital structure more debt is used, it is called high leverage. And if less debt is used, it is called low leverage. Now, capital structure is also called trading on equity or financial leverage. It could be asked by any of these three names. Now, this example is very important, and I'm going to use this example again and again later on in this video. Now, let us compare two companies, A and B. Both the companies are the same. Both have the same capital. Both have the same profit. But company A shareholders are getting 60 rupees per share, and company B shareholders are getting only 50 rupees per share. How is that possible? When both the companies have the same capital and the same profit, how did the finance manager of company A manage to give its shareholders 60 rupees per share, and the finance manager of company B could only give 50 rupees per share? Now let us study this and understand what actually happened. So let's start with A. The capital of A was 5 lakh. And equity was 2,50,000 out of the 5 lakh as capital. The finance manager issued 2,50,000 of equity and 2,50,000 of debentures. That means rupees 2,50,000 each. The profit was 50,000. Now 50,000 on 5 lakh comes to 10%. The profit was 10%. Now, out of the profit, first of all, interest has to be deducted because interest is a charge you have to pay. So the interest to be paid to the debenture holders was 8%. So 8% on 2,50,000 comes to 20,000. So let's deduct 20,000 from the profit that the company had earned. So what was left was 30,000. Now for easy calculation, I've taken tax at 50%. Every company has to pay tax. So if we deduct 50% as tax also, that is 15,000. So what was to be left to be distributed amongst the shareholders was 15,000. Now, what are the number of shareholders that were there? The number of shareholders were 250. Out of 2,50,000, the equity shareholder was of rupees 1,000 each. So that makes it 250 shareholders. So this 15,000 was divided amongst 250 shareholders. So per share, it came to rupees 60. Now come to company B. Now company B also had the capital of 5 lakh, but they just issued equity share. Company B never availed of debt. They did not raise any debt. The profit was also the same, 50,000. Now, since they did not raise debt, so they did not have to pay any interest. So the profit was 50,000, but they had to pay tax. So tax in their case was 50% of 50,000. That came to 25,000. So what was left to be distributed to the shareholders was 25,000. But in case of B, the number of shareholders were 500. So 25,000 was distributed amongst 500 shareholders. So this came to rupees 50 per share. Company A could give rupees 60 per share and company B could give only 50 per share. Why? Why did this happen? This happened because two conditions need to be fulfilled before any company can trade on equity. Two conditions were not fulfilled by B. Now, what are those two conditions? First, the rate of profit should be more than the rate of interest. Now, what is the rate of profit in this case? 10%. And what is the rate of interest? 8%. So what the company did was they earned 10%, but to half of the owners, that is the debt capital, they gave only 8%. So 2% they saved. That also went to the equity shareholders. And the second condition that needs to be fulfilled is that the security should be tax deductible. Now let us see that. What is the tax paid by company A? 15,000. What is the tax paid by company B? 25,000. So company A actually saved 10,000 in terms of tax also. So that benefit also went to the equity shareholders. Therefore, the equity shareholders earned rupees 60 per share in case of A and only 50 in case of B. So please remember, children, in this case, the debt was 8% and the profit was 10%. So the amount of debt, the rate of debt was much less than that of the equity. Now this brings us to one question, that if a company raises debt, then will it always be able to give more to the equity shareholders? So my next slide will help you answer that. Now we are taking three companies, A, B, and C. Again, they have the same capital and the same profit. But in this case, the rate of debenture is 12%. In the previous case, it was 8%. Here it is 12%. So let us see what happens. So again, the profit is 50,000. Now the interest to be paid will be 12% of 2,50,000. That comes to 30,000. So what is left after paying the interest is 20,000. Now tax again remains the same, 50%. So 10,000 goes in tax. So what is actually remaining is 10,000 to be distributed amongst 250 shareholders. So it comes to only rupees 40 per share. So therefore, there's nothing called optimum capital structure. You can't say that if I raise debt or if I raise only equity, then that is the optimum capital structure. Optimum capital structure is that structure in which the return to the equity is the maximum. Now, having understood that, let us come to the factors affecting it. I'll be referring to this table again and again also. First of all, what are the factors that help the finance manager determine the capital structure of a company? First is the cash flow position. If the cash flow position is strong, then the finance manager will go in for debt because interest has to be paid in cash. If you don't have in cash to pay interest, then how will you pay interest? So unless the cash flow position is strong, the finance manager will not go in for debt. So if the cash flow position is weak, then when he's making the capital structure of the company, he's deciding upon the capital structure of the company, he will go in for equity. The second thing that he has to keep in mind is the interest coverage ratio. Now, interest coverage ratio in this case that I have discussed with you was 2.5 times. How did we get that? See, the profit was 50,000, but the interest was 20,000. So interest is 20,000, the profit is covering interest 2.5 times. Suppose the profit was 60,000 and the interest was 20,000, then it was covering 3 times. So interest coverage ratio, if it is high, more the interest coverage ratio, then the finance manager will go in for debt because debt is definitely cheaper and the amount of interest to be paid on debt will easily be covered. But if the interest coverage ratio is low, then the finance manager will go in for less debt. Then come to debt service coverage ratio. This is the formula for debt service coverage ratio. Debt service coverage ratio basically tells us the potential that the finance manager has to raise more debt. Abhi to jo debt tha wo aapne raise kar liya. You have already raised the debt. You already have a capital structure. But what is the potential that you have to raise more debt in future? This ratio tells us about that. So if you have more potential, you can raise more debt, then he'll go in for more debt. But if the potential is less, you've already exhausted the amount of debt that you could have raised, then he will go in for less debt because flexibility also he has to keep. Then comes return on investment. The amount of debt that can be raised in the capital structure will depend upon the return on investment. In the case we had taken up, the return on investment was 10%. So the return on investment goes higher, then the finance manager will be able to pay the interest even better because the rate of interest was 8%. So if the ROI goes to 12%, then he's in a better position to pay the interest. So if the return on investment is high, then the finance manager will go in for debt, because debt is always cheaper. Finance manager is always interested in going for debt because then he can cut cost. But if the ROI is low, suppose rate of interest is 8% and your ROI is 9%, you're barely covering the interest. So if the ROI is low, then the finance manager will go in for less debt in the capital structure. Then come to the cost of debt. In this case, the cost of debt was 8% and the ROI was 10%. So if the cost of debt goes down even low, if the cost of debt becomes 6%, then the difference between the ROI and cost of debt becomes more. Then the equity shareholders gain more. So if the cost of debt is low, then the finance manager will go in for more debt. But if the cost of debt is high, then the finance manager will go in for less debt. Then come to the tax rate. Now this I'll have to explain with the help of a slide. Yes. Now in the previous case, I've just modified that. A and B were the two companies and the tax was 50%, and company A paid 15,000 as tax and company B paid 25,000 as tax. So company A saved 10,000 as tax. Now let us take the case where the tax rate has gone up to 60%. Now 60% of 30,000 comes to 18,000. And 60% of 50,000 in case of B comes to 30,000. Now the tax saved is 12,000. More the tax saved, more will be the benefit to the equity shareholders. So if the tax rate is high, the finance manager will go in for more debt because debt will become even cheaper. And if the tax rate is low, then the finance manager will go in for less debt. Then comes the cost of equity. Cost of equity is the expectation of the equity shareholders. Now, suppose the finance manager wants to go in for debt because debt is quite cheap. But when he raises debt, he raises the risk. And more the risk, more the return. So if he uses more debt, then the equity shareholders expect more in return. Why? Because they're bearing the entire risk. And if the debt keeps on increasing, the expectation of the equity shareholders keeps on increasing. Because there's more debt, they're expecting more return because risk should equal to return. And therefore, the expectations go up so much that whatever the finance manager declares as dividend, they're not satisfied. They think they're incurring too much of risk. That is why the finance manager cannot raise debt beyond a certain limit, because otherwise, because of more debt, the risk becomes more. And the cost of equity, instead of going down, will actually come down because the expectation of the equity shareholders becomes skyrocket. So look at that funny diagram that I've put in here, that they're being crushed by the weight of debt because debt is cheap, but it is very risky. And this risk has to be borne by the equity shareholders. Therefore, they expect equal amount of return. And if the finance manager is not able to give them the amount of return that they're expecting, then in that case, the market value of shares may actually go down. Yet another factor that the finance manager considers while he's making the capital structure is the flotation cost, that is the cost of raising resources. So what is the cost of raising funds? In equity, the cost is a lot because he has to take out advertisement in the newspaper, etc. A lot of formalities are there. But in case of debt, the flotation cost is very less. So in case flotation cost is a criteria, he will go in for debt because the flotation cost of debt is much less. Come to risk considerations. Now, risk can be divided into two categories. There are two types of risk: financial risk and business or operating risk. Financial risk is the risk of raising finance or debt. The risk associated with debt capital is called financial risk, like interest to be paid, the amount to be returned, etc. And operating or business risk is the risk of running the business. So if your operating risk is very high, that means you're already paying a lot of rent and salary and everything, then if you complicate that by adding more of interest to that, then the amount of risk, financial risk will plus operating risk will be very high. So if the risk becomes very high, then the finance manager will go in for equity, because equity is not as risky as debt. But if you have your own building and you don't have to pay rent, so business risk is much less, then you can take a little amount of financial risk. So if the risk consideration is less, then the finance manager will go in for debt. Then comes flexibility. See, there is a ratio that has to be maintained around 2:1 ratio between debt and equity, which is suggested by the Companies Act also. So the finance manager wants to keep some flexibility. Now, if he wants to raise debt in the future, he wants to have some flexibility so that if he needs funds in the future, he should be able to raise it. So if the finance manager wants more flexibility, then he will raise less debt, because if he exhausts the limit of raising debt, then he will not be able to raise any further debt in future in case he needs it. So to be able to keep flexibility, the finance manager will issue less debt. Then comes the stock market conditions. The stock market has got basically two conditions. One is bullish market or bearish market. Now, bullish market is when the price of shares are going up. Just like a bull, when in a bullfight, the bull tosses the victim up in the air. Similarly, just like the bull is tossing the victim up in the air, similarly, when the price of shares are going up, we say the market is bullish. So when the market is bullish, everybody is interested in buying equity. Therefore, the finance manager will go in for equity in the share capital, in the capital structure. But when the market is bearish, means the prices are going down, the market is not showing any rise. So just like a bear, when a bear is attacking somebody, the bear pounces on the victim and grounds him. So when the prices are going down, then people don't buy equity. Then the capital structure will have more of debt. Then comes the regulatory framework. Now, SEBI has given guidelines. Companies Act also keeps an eye on that. And SEBI says that idle would be 2:1. So according to the SEBI guidelines, the finance manager decides the capital structure. He cannot go beyond that, because otherwise the business becomes very risky. Trying to cut cost, he may actually make the business very risky. So this, the SEBI will never allow. So regulatory framework also has to be followed by the finance manager, which is 2:1. Then comes the capital structure of the other companies. Now, the finance manager keeps a very close eye on the capital structure of the other companies. Remember, I had compared 3 companies. So each company keeps an eye on the other company and see how they're doing, especially when the share capital is the same and the amount of profit is also the same. But don't follow them blindly. Suppose they have raised debt. Why? Because the operating cost, operating risk is very less. So they raise debt and you also raise debt. But your operating cost and operating risk is already very high. So your business has become very high. Now your shareholders are not happy with it, because they're bearing all the risk. They want more expectation. And despite you giving them a lot of dividend, they're still not happy. So keep an eye on what the other people are doing, but don't follow them blindly. And then finally, the control. Now, the finance manager has to see the interest of the equity shareholders. So if he issues more equity shareholders and it dilutes the control of the existing shareholders, then they will not like it. So he sees that by issuing more equity shareholders, is the control of the existing equity shareholders diluted or not. If it dilutes their control, then he'll go in for debt. If it doesn't dilute, then he'll go in for equity. I've explained this point before also. Let me do it again. Suppose there are 100 equity shareholders and he wants to raise more capital for the capital structure, and 100 new equity shareholders are going to join. So the control of the previous equity shareholders goes down to 50%. Now suppose there are 100 equity shareholders and now 10 more have to be added. Little more equity share has to be raised. So the original 100 equity shareholder, their control is marginally diluted. So it doesn't affect them much. So therefore, in that case, the finance manager, in the lower case, the finance manager will go in for equity, and in the first case, he'll go in for debt. Now that brings us to the case study at the end of the video. So let's do it. Now here, we'll again read the question first, what has been asked, and then accordingly, we'll try to attempt it. Should the company proceed with its plans? Now, what are the plans? Let's see. Now, XYZ is a company, equity capital is 10 lakh, earnings before interest and tax 50. Okay, 50,000. The company is in need of 5 lakh for expansion, and it has decided to go in for debt funds, which are available at 7%. Prevailing tax rate is 30%. Should the company proceed with its plans? So I'll give you a moment to calculate it. In fact, I'll give little more than a moment. Let's see if you can do it. Then I'll explain it to you orally first, and then we'll do the solution. You can see that the earnings are only 5%, but the debt is 7%. So debt is more than the earnings. So I would suggest that the finance manager should not go in for debt. This is what you can see from the question itself. Now let us see. Yes, the company should not opt for debt financing. Now, this has been explained because they've said give reasons also. So we are starting with the earnings. So 50,000 is the earning in both the cases. In the first case, suppose they don't take debt, and the second case, they go in for debt. So the earnings now remain 50,000 if they don't go in for debt, no interest is to be paid. And there, the interest has to be paid, that is 15,000. So after tax, 30% tax is to be calculated. 30% tax on 50,000 is 15,000 in the first case, and 30% tax on 15,000 is only 4,500. So earnings after tax in the first case is 35,000, whereas in the second case it is 10,500. Now look at the share capital, that was 10 lakh in both the cases. So in the first case, the equity shareholders got 3.5%. In the second case, they got only 1.05%. So definitely, if the company did not raise debt, then the equity shareholders earned more. So therefore, we strongly suggest that the company should not go in for debt financing. That's in this video, children. Thank you.